Hey, welcome back, everybody, to the Financial Advisors Workshop. This is the show where we interview folks in our industry that are financial advisors working directly with individual investor clients, and how it goes and how it works and how they run their practice. And we're meeting some really great people. Today we have Chris Manske, who runs Manske Wealth, and he's going to tell us a lot about what he's doing. So Chris, welcome to the Financial Advisors Workshop.
Thank you. Love to be on the show.
Excellent. Now you're in the great state of Texas, and but you're a West Point grad. Give us a little bit of history of, your personal history, and then let's talk a little bit about how you got in the business. Give us that progression.
I'd love to. So my history begins at the academy, West Point, and then I went into the Army. I left the military as a captain after almost 6 years being all over the world. And I came back to Texas because I'd fallen in love with a Texan. And because of a good friend of mine who was already at Merrill Lynch, I applied to be an advisor at Merrill Lynch. And that's where I spent a little over a decade at the beginning of my career. And then in 2012, I started Manske Wealth Management. And Manske Wealth Management's been recognized by Financial Advisor magazine a number of times as one of the larger firms in the nation. And we just got it recognized by Advisor Hub as the 2023 fastest growing in the nation. So we keep pushing. We're really enjoying serving clients. And it's been a fast 23, 24 years.
Nice. So you started at Merrill. Now that was before the change of B of A and all that. So tell us about Merrill. How was that?
Yeah, it was an interesting focus on the sales side. And so I found myself putting a lot of energy into my own insecurities about not being good at the investment side. I came from the military and I felt like I didn't have the depth and finance that I needed. And it seemed like the brokerage was a lot more focused on giving me depth in how to meet new people and get them to sign on the dotted line. And not that that's a bad thing, but, I was spending, I'm going to say maybe 6 or 7 years with a little bit of a chip on my shoulder, like, oh gosh, I hope I know enough about investing. I hope I'm good enough at investing.
So it was a good foundational thing. And you did learn. Did you end up being good at investing?
I think so. Yeah, I think I got okay at it.
Good. Okay. So you did 10 years there, and then when did you leave?
2012. So it was a few years after the BOA takeover, and and I didn't leave because of that. It was more that it just on my journey, it was just a good time for me to move into more of a leadership role and have more control over the culture of the team around me.
Good. So all right. So then you start Manske Wealth. So how did that come about? You looked at other firms and then decided to start your own, or you just really wanted to strike out?
I really just wanted to start my own. From age 17 to 27, I was at West Point and in the Army, and leadership was a real formative idea for who I am and what makes me tick. And so it just seemed like the right fit right from the start.
Nice. So tell us how you designed it. You have $500 million now, but with the start, what was it like, and systems and everything?
Yeah, so we're a fee-only fiduciary shop. We have no investment in the extracurriculars. Like, we don't do taxes, we don't do estate planning, we don't do insurance. And I think you can define yourself a lot by what you don't do. And so we don't do those things. We'll partner up with other experts that focus only on that. And so when a client hires us, we're their planner and their investment expert. And when there's other needs, we make sure that there's someone else that comes in and gives them an expert opinion on that.
Nice. So when you started the firm, did you have to get a bunch of different systems, or did you sign on with a certain custodian that had systems, and how did all that work?
Yeah, so I interviewed different custodians, and at that time, Charles Schwab was a great fit for us. They had a wonderful consultancy team that could, help us with the transition from, being at Merrill to being on our own. And And I'm good at following orders. The consultant said, do this, do that. And we did it. And it was a very smooth transition. There really, I don't have any stories of difficulty as far as the actual systems themselves. I mean, in the end, we went with what I think are pretty standard, industry standard approaches to money management when you're working with a custodian. So we've got Morningstar, and we use Morningstar Office. We've got all the bells and whistles that go with a few financial planning packages, a good CRM, stuff like that.
Excellent. What CRM did you use?
So we started off with Morningstar Office's internal CRM, and then we moved to Redtail.
Okay. So you still use Redtail now?
Yes.
Are you using Orion also?
No, we haven't looked into Orion.
Okay. And because Redtail now is owned by Orion, of course.
Oh, okay.
Yeah. So, okay, well, good. So, then how do you run the money? Are you a manager yourself?
Yes, we do the investment selection. We look at analysis and analyst opinion from a variety of sources. We parse that through our investment committee and then make the buy sells accordingly for clients.
Okay, excellent. All right, so you design their portfolios, you run it. You do financial planning also?
Correct.
Great. So how does that all work with the client experience? They get a financial plan at the beginning and then you track it, or do you periodically look at it, or how does that work?
Yeah, we will look at the financial plan at least once a year. And when someone first hires us, the financial plan is something that we create for them in the first 8 weeks that we work with them.
Okay, great. So it's a foundational thing for the relationship. And then I assume you track it through as well. And
it's all done inside of software that is, firm software. So we can see those plans, and we can see as things change for the client, we can go in and make those updates, and we can track those changes. But I'm sure that all of this is pretty standard. I mean, most firms are doing this, I think.
Well, many are, and some are, so it's good to know how you run it. But now you're also a thought leader in the industry, Chris, and you've written a book, The Prepared Investor, in 2020. Let's talk about that. Tell us about your book.
Sure. So my first book is about how Wall Street is failing us with the typical approach to crisis investing. The typical approach is stay the course, just hold on, it'll come back someday. And that approach is really missing a lot of nuance, because different crises affect the market different ways. And with just a little bit of attention to, the pattern that is created by certain market events, you really can do good things for clients in the face of terrible crisis. It's not to say that it's bad advice to sit and wait, because there are some market events where that does make sense. But in the case of threats like a terrorist attack or an imminent concern about war, the market has a very clear response to those kinds of crises. And it's good to understand that response and be able to talk to clients directly about what to expect, instead of, hey, something bad's happening, and so we always just do the same thing. We always just stay the course and put our head in the sand, which, is, again, not always terrible, but there is another way. And this time of year, the book gets a lot more attention than normal, because there's a section in the book about 9/11 that has gotten a lot of attention. Some real nice reviews about, the story behind 9/11 and, the touching aspect of the prose, I guess. I'm talking in what other people are saying about my book, not me. But yeah. And it's not a self-published book. I think sometimes it's good to make that clear that, it's a traditionally published book, and it's a great read that I hope people in finance get a hold of.
It's available on Amazon as well, and you can buy it electronic. Yeah. Great. So again, folks, the title is
The Prepared Investor.
Prepared Investor. So give us an insight into what would you do differently in a crisis like it? So let's talk about last year, 2022. I'd say that is big a crisis as I can remember. What would be differently? What might you do differently in a year like last year? What did you do differently?
Yeah, sure. Well, I think what I'd love to do is to go back just a little bit further to something that's in the book, so that people can, read about what I'm talking about right now. So, if we go back to the COVID crisis, which that would be 2020. So just go back a couple more years. We had this virus that came out and was public, and we knew that it existed in January. There was a lot of concern about it. And, February, about the middle of February, concern started to ebb away. But then all of a sudden, things got really hairy with the stock market. And it was maybe March the 8th, March the 9th that the market dropped like crazy. And so the reason that all occurred was because of quarantine. Nobody had seen quarantine before. And so when you're looking at a crisis, if you're looking at it from the point of view of, there's a number of different ways that I go through in the book, but one of them is you're looking for that thing that people are not aware of yet, that it's new to them. And when they have never experienced it before, there's a fear that drives the market down, and it's very temporary. I mean, sometimes just a day or two, sometimes a month or two, but it's never in the history of the stock market. Those kinds of events have never taken more than 6 months to return from. So, I mean, we're not talking about, you got to wait for years for it to come back. It's really fast, sometimes just a matter of days. And so that quarantine event, we think about how hard it was and how difficult it was, and it was to live through it. But the market, the down and up was very V looking and was very fast. And then afterwards there was some real scary moments. But that initial reaction, as you're watching the news, it's very clear and easy to predict. And you could see that. You could go back in time to like the Kent State shooting. It's the exact same thing. At that time, we as a nation just had no experience at all with our own military shooting at our kids on a college campus. It just didn't resonate with us. We were still naive as far as that goes. And so the market pattern looks very, very similar. And so when people read The Prepared Investor, they're getting these stories of history alongside the action steps that describe, look, this is, if you just keep your eye out for this, and here's how you keep your eye out for it, you really can make excellent decisions that protect your wealth, or maybe even grow it in times of crisis.
So, so tactically, do you raise some cash? I would suspect, to protect the value, and did you do some reverse, like shorting or that kind of thing? Is that? Yeah.
So I talk about those different approaches in the book, because really, the pattern is the thing that is the magical thing that we need to be aware of. Once you know the pattern, there really is an eternity of ways that people can try to take advantage of it. If you want to be more conservative, you would just, maybe wait until it's down a certain amount and then just go long and buy in and sell after a particular amount of profit, and you're in and out. That would be one approach. Another approach would be to use margin and do that same kind of thing. And in between those two, you've got the bear side, and you've got the shorting, and you've got the 3X ETFs on the down and the up. There's so many ways that you can take advantage of a pattern, but understanding that pattern and being ready for it. Because, the fact is, these crises, they don't come every day. They really don't. But there is another one coming in the future. And so being ready for it, it's not something that you are thinking about on a daily, weekly, and maybe even annual basis. But then when it hits, it's nice when you're prepared and when you're ready for it. It really is.
So why do you think people don't do that? It's a little scary, isn't it?
It is. Well, I think there's a number of reasons why people don't do it, but the main reason is because it's a lot easier to understand wait. Hold on, just wait. That's a lot easier to understand, and it's a lot more effortless to do. I just do nothing. And so it's not that that's bad advice, because even a stopped clock is correct, twice a day, right? Yeah. So, that's what's happening here, is that there are times when the way to manage yourself is hunker down and wait for this to pass. But that's not always the way. And I think, unfortunately, we lose the nuance. And this actually talks to my next book, Outsmart the Money Magicians, because that nuance, we lose it because I think the brokerage system is directing advisors and training the financial sector toward that lowest common denominator that'll just work for everybody and have as little compliance impact as possible, instead of a higher level nuanced approach that empowers advisors and really gives clients a top tier sophisticated money management. And I think I think that when somebody picks up the Prepared Investor, the reaction is usually a big thank you. And I've been so grateful to get the notes and the emails from folks who have read it. And, when you go on Amazon, you can see people that they make these reviews, and I read them, and I just, feel so grateful for it. It's amazing.
Great. So, so that's the gist of the book. Anything else in the new book? And you just mentioned that.
Well, sure. Yeah. So the new book, Outsmart the Money Magicians, it's coming out from McGraw-Hill, and it is talking to that disparity between the brokerage system and what advisors are hungry for and what clients are hungry for, because there really is a big disparity. And I'll give you a quick example. I'll give you two quick examples. So the first one is quotas. I mean, it's common sense. I think anyone who's listening to your podcast, they're probably immediately on board that, yeah, quotas, they pressure the advisor in bad ways. There's a desperation sometimes. And I mean, you think about that new advisor and she's working under a quota, she is a bit more vulnerable to criminals. It's a lot easier for some hardened money launderer to take advantage of her than it is somebody that doesn't have a quota that's hanging over their head and their job is not on the line. But from the client point of view too, it's the same. The client just hired their new advisor, and then 6 months later, that advisor is gone because of the quota. That client's not jumping up and down for joy about that. This is just a systemic disconnect between, what the brokerage is, creating for the financial sector and what really is good. I'll give you another one because the book's called Outsmart the Money Magicians. There's a lot of magic metaphor that's going on in the book. So my other quick example is CPI. And so to talk about CPI, let's think back to, our grandparents. They're in a magician's theater, and the magician points to somebody in the theater and he says, "I want you to be my volunteer. Come up here." And our grandparents were like, "Yeah, okay, this is good." But we have education and we're not as naive anymore. We know that the first question that's going to go through our minds is, well, wait a minute, you just picked that volunteer yourself. That person, that supposed volunteer, is probably part of the act. We have that education. That trick just doesn't work anymore. The same thing with saw a woman in half. There's no magician anymore ever that's going to saw a person in half on stage, because we know how the box works. Well, yeah, once you know how a trick is done, you can't go back. And that's where we get to CPI, because CPI is a volunteer in the audience. The government tells us that CPI is a measurement of inflation. And the vast majority of our clients, when they think inflation, they think CPI. But if you talk with experts, they will tell you that it is not a measurement of inflation. And when you go behind the scenes, what we have here is we have a government that is changing the way that CPI is calculated. And they've changed it more than 20 times since I've been alive. How can something that's supposed to measure a long-term economic effect be accurate if it's being changed so many times over and over and over again? Oh, and by the way, the same government that is changing it over and over again, they're required to use that index to pay debt service, to pay benefits to millions of people with Social Security or government pensions. So, I mean, imagine that. Where in any system do you have the person who has to pay a debt also have control over the measurement that determines how much they pay? You know, I think it's clear that the volunteer in the audience is part of the act. And once you're aware of that, you can't go back. You know, this can't be undone. We now know that, you know, it doesn't work. And I think really the more that people read Outsmart the Money Magicians, the more that all of us are going to say we can't go back to how it was, and we can raise our standards together. You know, Peter Schiff, the famous economist, he did an awesome experiment on CPI. And I think anyone listening to this could do the exact same experiment because it's so simple. So Schiff is famous because he predicted 2008 really well. And he said CPI doesn't measure inflation. I'm going to show you. And he took the media and periodicals government data. So this is stuff like magazines and newspapers. And he says the government says that CPI for that is 3% a year. So it was 30% for a decade. You went back over 10 years. It was 30% for the decade. And so then he went on the internet, and anyone could do this. And because magazines have the price right on the cover. And so he looked at like 40 of the most popular magazines every year for the whole decade. And the actual price increase was not 30%. It was not 40%. It was not 50%. It was over 130%.
Wow.
CPI is a volunteer in the audience, and we've got to start asking the questions that, and seeing this properly. 130%, that's 3% is what we're told by the government, and 13% is what is reality. The time has come.
Yeah. So then how do we take advantage of that where folks don't understand CPI and what inflation really is? And we had a recent huge bout of inflation again, like the 70s. So what are the opportunities there?
Well, I think a big opportunity is to just first, all of us recognize that there is a little bit of trickery going on here. I mean, I just think that is a huge movement forward. Instead of just accepting, what's going on and accepting what our indexes or our, brokerage systemic requirements are, we should question them. And I think once you start looking at it a certain way, like, for example, the quota, as soon as you look at it from the point of view of who does this benefit, and it's not the advisor and it's not the client, well, there's a little bit of trickery going on here. I mean, why is this a systemic norm? It shouldn't be. Does it have to be? No, it definitely doesn't. My firm is a perfect example of that, where we've grown extremely well and never used a quota. And I know a lot of on the independent side where, they're wanting a culture where it's not dog eat dog, and they're wanting a culture where it's supportive, and and the quota is old news.
Interesting. Good. So we're going to learn a lot more about financial magic and financial trickery, which is good.
Yeah. Outsmart the money magicians.
Excellent. So great. So what trends are you seeing right now that you maybe could share with our investors? And it's based on what we've been through in the last year and a half, which has been really crazy. Inflation seems to be coming back now with the recent numbers from the month of August. So what would you suggest to investors to do now?
Well, I think it's important that people pay attention to our national debt. I think that there's a trend there that just is not getting enough air coverage. It's not getting enough talking about, and that is that we've got a deficit each year. Our national debt is getting bigger, and it's going to have a impact. And while we don't know exactly when the impact's going to be, we do know that, there's going to need to be some kind of a reckoning. And perhaps that reckoning is going to be changes in the tax situation. Perhaps that means more taxes. maybe it means that there'll be a lot more inflation as the dollar gets to be less valuable, as more dollars are needed in the system to be able to take care of the debt service. I don't think that it's something that is doom and gloom, like it's the end of the American society. And that's important to say because some people, they really have that idea that, okay, well, that means that our country is going to end. And it's not what that means. But it does mean that we're probably going to have higher taxes. It does mean that, we've got a reason to see more inflation in the future. So that to me is something that's important that people keep an eye on. And if they want to do more, they could look at they could look at organizations like Coalition for a Cause, or just Google any U.S. debt clock or world debt clock and take a look at who's funding those things and get involved. It's something that I talk about in the book, Outsmart the Money Magicians, because there is a little bit of a problem with what people are perceiving to be true and what is true. And the perception is that, oh, well, we'll be fine for another 50 years. And I'm not sure that I agree with that.
So we've got this massive debt now, and it's going to cause inflation, we believe, in the future and other things. Is there any way out of this as a country? Are we destined to be underperforming now because we've got so much debt, and are we destined for sure to have inflation? How do you solve this, Chris?
Well, I think it's a leadership issue. And I know that your podcast isn't a political one, so it doesn't have to be politics. It's more just, it doesn't matter which side of the aisle you're on. Leadership will help to guide a nation in the direction that is good for the nation. And, and if somebody is listening and they're Democratic, well, a Democrat, Bill Clinton, was the last president that actually did lower our national debt. If you're a Republican, okay, well, a lot of times the Republicans are considered to be more hawkish and more conservative. Either way, if you want to see our nation's financial strength increased, that means that, leadership needs to put focus on it and help to move this in that direction. I don't think we're destined to just have terrible inflation forever. I think that with good leadership, we can make good decisions that lead to a balanced budget and to lowering our overall debt. And it's not something that's going to be solved overnight, but it is something that can be solved.
Great. And what other trends do you see out there for investing? Will we see commodities come back? Are we positive on stocks? Well, let's say 5 years, Chris. What do you see out there?
Well, I think we're going to see a lot more people focused on income as interest rates continue to go up. And I don't think that 5 years from now, they'll be back at, 2, 3, 4%. I think that they're going to be higher than they are now. I think you're going to see a lot more focus on income and a lot more stress for financial advisors because they're going to be competing with cash instruments. There was a day when, a municipal bond was paying a lot more than any dividend on any stock. And I think those days are coming again. And 5 years from now, we'll probably start seeing the beginning of something like that. And it's good for advisors to be ready for that. I think if we're thinking about being real well-versed in money market instruments and in how we handle bonds, individual bonds, and not just the ETFs and mutual funds, I think that's probably a good thing to start looking at seriously now so that then when it's necessary later, you're ready.
Nice. Well, we talked a lot also, Chris, earlier about our industry and how our industry has failed the advisors and many investors. Let's talk a little bit about that. I mean, there seemed to be a big sea change among the firms like a Merrill or Morgan Stanley, the big wirehouse firms, and what is being solved there and who's solving what's happening there?
Well, I'm not sure that we're seeing anything being solved at the brokerage level. It's more like there's a transition away from the brokerage system so that the advisors can be in a system that really is aligned with the clients. And I think that the recent regulatory changes like Reg BI, the best interest regulations that affect the brokerage houses, it's a Band-Aid. It doesn't really cover the needs that the advisory force has. And you can see that because suitable standard, which suitability, I think, is like drunk driving, like it needs to be gone. Suitability is like not letting women vote. Suitability is not appropriate for, Main Street when it's interacting with Wall Street. But anyway, so suitability is still a part of any household that has a business account or any household that has a trust account. And that means that Reg BI just didn't go the distance, sadly.
So Reg BI is not the solution either?
No, I don't think Reg BI is the solution, but it is a step toward the solution. I think the next step is that they need to make that best interest regulation cover everything that the brokerage house does. But as it stands now, there's still so many loopholes and so many ways that the brokerage house is doing double dealing, whether it's collecting fees from the firm that they're bringing public at the same time they're collecting fees from the people buying the shares. There's just a lot of that going on. And just because the brokerage house discloses it in a mountain of compliance language, that doesn't make it okay. That doesn't mean it's good. It just means that they're doing something that's not right for the advisors and the clients, and they're hiding it in plain sight, and that's not right.
Yes. So the answer is to be a fiduciary, wouldn't you say?
I think that that is a great approach, but I'm also biased because I've been a fiduciary now since 2012, and it has been a wonderful experiment. I've seen growth. I've seen advisors that work with me who have just really felt wonderfully rewarded by their work. And I don't just mean monetarily. I mean, in the way that matters, coming into work and being glad to be around the people that you're with and not feeling like you're pitted against each other. And, the fact that that you're systemically focused on what's best for the client instead of, I got to talk around this because these mutual funds are actually the brokerage's mutual funds, and I'm getting paid a little bit more to represent these funds to you. That just doesn't exist when you're on the fiduciary independent side.
Yes. So they make compromises and it's not in the best interest of the client, for sure.
Yeah, that's right.
Yeah. Well, great. I think at FourStar, we agree with you on that, Chris. And I think that the clients are better served in the fiduciary environment. So that's wonderful. We got some great ideas, Chris. You built a great business, and being independent's really helped you flourish and create a $500 million firm, which is really exciting.
Yeah, thank you. I'm really glad to share with others. Maybe someone will hear this and, maybe they'll buy Outsmart the Money Magicians, but I hope also they'll think about, raising the standards for Wall Street as a whole.
And that would be great. Well, thanks for spending some time with us, Chris. And folks, don't forget the Prepared Investor, which talks about crisis investing and what you can do differently. And FourStar is a proponent of that as well, with rotation models to get out of the market and try to do things differently than, like I call it, the write it down portfolio. We don't want to just write it all the way down and it'll come back someday. I think we're tired of doing that. So you can learn a lot about how to handle that in the Prepared Investor, which is of course available on Amazon Books. And then we'll look for the new book, Outsmart the Money Magicians.
Yes. Yeah, McGraw-Hill's publishing it, and I think the reason that they're putting it out there is because there's something important that needs to be said about how Wall Street can do better.
Yes. Well, great. And in the meantime, for those investors who are listening who are not with a fiduciary advisor, get with a fiduciary advisor because they don't have all the conflicts of the old school firms where they're taking fees hither and yon, hidden back room, up and down. They disclose everything and they're right for you. And Chris, you're right for the investing public as well. So we'll leave it there today, Chris. Thanks everybody for being with us. Thanks, Chris, for being our guest today.
It's been a pleasure.
And we'll look forward to another interview soon with another really great, as you can tell, we have some great people in the financial advisory industry, and Chris, you're one of them. And we look forward to another interview with a great person like you, Chris. And we'll leave it there. Good day, everybody. Take care.